Welcome.
Hi.
I will give a short introduction of what we're going to do in the next hour. We're going to talk about EMU and finance in Europe. 10, 15 years ago, the euro went through its worst crisis. It was the great financial crisis that showed that the financial sector, financial flows, and the rise of private debt can become a destabilizing force in a monetary union. What lessons have been learned and what has been done to prevent a recurrence, and what plans still have not been implemented. Let me briefly introduce you to our final two speakers. William de Vijlder is Group Chief Economist at BNP Paribas. He began his career in the Economic Research Department at Belgium's Generale de Banque in 1987. He was Global Chief Investment Officer at Fortis Investments, and when Fortis merged with BNP Paribas in 2010, he became a member of the Executive Committee of BNP Paribas Investment Partners. Welcome. Linda Zeilina is the founder and CEO of the International Sustainable Finance Center, where she oversees its work on sustainability strategies, sustainable investing, and ESG standardization efforts. In the past, you have worked on large-scale consulting projects for institutional investors and banks across Europe. Linda, welcome. Mr. de Vijlder, do you agree with Mr. Knot that a strong capital markets union and a banking union in Europe are key in decreasing risks and making the EU crisis-proof?
Yes, but I would go further. I think you have one element which you clearly emphasize strongly to make the house more resilient, more solid. I'm referring to the metaphor of the 5 Presidents report of a couple of years ago. So that's one very important point. The other important point is that we have major challenges ahead of us. To say the obvious, one is the energy transition, all the investments that are required. Depending on the source that you're looking at, the ballpark number ranges between 500 billion per year that needs to be financed. I recently saw 1,000 billion a year. That's a new estimate to be seen. If you look at, again, ballpark numbers, what is the annual financing within the Eurozone? It is about 400 to 450 billion a year that is already being financed. So if you have to add on top of that, say 500 billion, that is a lot of money. So what you need is, you need a strong, resilient, dynamic banking sector that can do its part of the lifting, and gradually you also need to have capital markets, of course, because I don't know whether anybody has already run the numbers, whether it's even possible to envisage that the banking system at present would be able to reach these amounts of additional financing. So if we cannot reach these amounts, what's going to happen? Either you would have an interest rate effect that is going to crowd out certain investments that are also needed, but that people cannot do, or you have to hope that you would have foreign capital inflows, or you could have other banks starting to kind of make a living of all the investment needs that we need to do. I'm of course thinking about the US banks. We can extend this also in terms of the digitalization, and simply because we are in an environment that we need to have a lot of companies, startups, it was mentioned in the previous panel, that also need to be financed. And as Maria has mentioned, there is an issue when you get to startup and you need to venture, then all of a sudden it's as if the financing stops and we need to look abroad. And why is that? Because typical Euro area institutional investors use their risk budget in a fully efficient way, so their maximum risk budget. So who is going to do the extra financing? Typically you think about Anglo-Saxon investors. And my key point in that respect is that if you rely on Anglo-Saxon investors, they tend to come in and out depending on how the business cycle goes. So that makes you more fragile to mood swings in terms of risk appetite. But the other very important thing is that eventually the economic value will be created where the financing is coming from. So if the financing is being conducted by US private equity funds and venture capital funds, eventually the economic value added and the tax base will move to the US.
Clear.
That's why we need CMU.
Capital Markets Union. Yes, Linda Zeilina, was there anything that, in your opinion, was missing in Mr. Knot's speech?
Oh, I actually really enjoyed the speech. I thought it covered multiple points that I also wanted to bring up, so I think it was excellent. So, as the sometimes token Central Eastern European, I'm Latvian, and I run a think tank in Prague that operates across the CE region, and also somebody who works on sustainable finance. I think that there are two very big elephants in the room, and actually to build on your point, currently what we have is massive transition needs. There is a very big issue that we see currently in terms of the fact that we still have Poland with their own currency, you have Czech Republic with its own currency, you have very heavily industrialized countries. So their basic priorities are very different from what we're seeing in the West. The tone of the conversation and the content of the conversation is very different. It came as a big shock that only last year we built a big sustainable finance conference. People thought nobody was going to show up. The government didn't think there's going to be enough people wanting to talk about it. They actually did show up, and they were quite shocked and amazed that this is even a topic, that the business wants to listen. And I think that that is one of the biggest issues that we have with Capital Markets Union. Yes, we have a lot of money in the West in pension funds. We used to advise big ones all across the developed economies, looking for opportunity where to park their money. They want to go sustainable, whatever it means, under their bespoke trajectory that they've created. But where in the real economy can you park your money? And that is a very big problem that we have. We don't have a good transmission, allocation mechanism that moves the money for productive transition projects.
How can we solve that?
Well, I do agree with Capital Markets Union. There needs to be much more progress made and much more rapidly. If you actually look at the progress over the last several years, it's been very slow. We have multiple fighting over the taxonomy. Okay, we win the battle, there will be a taxonomy, then boom, we have delegated act, right? Gas and nuclear goes in. This creates big confusion. Immediately all the other countries go, oh, UK, by the way, going, oh, we're going to do a better taxonomy. We will not put gas in. So that leads to further fragmentation also in terms of standards. And if you're an investor, you want some clarity, you want some comparison. There's a lot of moaning about it. But at the same time, it's not an issue we cannot solve. So I do agree that Capital Markets Union needs to be strengthened. There needs to be a lot more done also about capacity building. One of the things that's very obvious also today, right? We mentioned climate. Yes, there's transition needs. You know, we have sustainability, climate risk, et cetera, ECB, of course, working on climate stress tests. But if you actually look at it, it's very, very siloed. It was like a little afterthought. Oh yeah, there is that in that little bubble that you call sustainability. But if you think about what is a massive fundamental risk to the economic system as a whole is natural capital on which all of our food systems rely, business relies, etc. So I think one of the biggest tasks is now to work on this next crisis, right? We know that it will come at one point, sooner or later. You only need to look at IPCC and talk to scientists. You know that this is a real risk and it's a build-up in the system. And what we need to do a lot more is actually the research of how these complex factors interact and figure out how do you create policies that incentivize the transition. And I mean, it's not an easy task, right? And I agree that it might need to have tweaking and be a little bit ambiguous at times, but I think some things need to be clear. There needs to be a much, much clearer strategy towards how do you try to get there? What are we signaling to the markets? Are we serious about Green Deal or are we not?
We are going to talk about climate change and monetary policy in a little bit. First, the Banking Union and the Capital Markets Union. Mr. Knot, you are an avid supporter of both of them. It has been, how long? 11, 12 years now? Yeah. Since it was brought up. Aren't you frustrated by now that it's taking so long?
Well, frustrated is a word that I try to stay a little bit away from, but it is clear that we are missing an opportunity here. It's quite clear that sort of we are, I mean, if we were to deepen the banking union, and we would truly see more cross-border banking services, etc., we would be using the numbers, as I was saying also in my address over there, much more efficiently. The issue is basically stuck on that in one part of Europe there is a huge sort of resistance against having a capital treatment of sovereign risk, and in the other part of Europe, that is in some other European countries, let me put it like this, that is used as a sort of excuse to say, oh, but we cannot share risk because these risks in these banking systems that are not capitalizing for sovereign risk is so humongous. We need to have a level playing field first before we can start sharing these risks. I think in the past, European integration has always proceeded by finding a compromise that, yes, we do a little bit more risk pricing here, but then we do also a little bit more risk sharing there. And it's very sad that on this specific file we cannot seem to find that compromise.
How do we refloat the vessel of the banking union?
Well, ultimately this is a purely political question. I think from a technocratic perspective, everybody exactly knows what needs to happen and what needs to be done. We need to convince our political masters that there is a lost opportunity here in terms of European prosperity. I think there is enough scientific research, the papers are there, the arguments are all very well developed. It is just overcoming fear, I think, overcoming political fear for backlash that I think should not be there.
Have politicians also maybe lost interest because the euro crisis happened some time ago?
Well, it doesn't help that this is not a very visible thing. So if you are a politician, it's very difficult to explain it to your voters why it is important. But it is massively important. But unfortunately, well, it doesn't resound well.
William, same question to you. How do we refloat this vessel of the banking union?
Well, I agree to what President Knot said. I mean, technically it's all there, but you need a political will. I think what the issue that we're facing now, and it's good that we have the conference here, is that it's a bit the carrot and the stick. So if you think about the adjustment processes that countries went through, I'm from Belgium, so I mean, the fiscal adjustment in Belgium in the 90s was like incredible. Yeah. Were there demonstrations in the street? There have been some, I mean, not really massive. And why is that? Because there was a kind of a shared ambition. We need to join, and that's where we want to go to. Whereas today, it's very difficult. So if you cannot really come with an argument, unless we have to do this, and that, it's not the unless, but we have to do this, and that will be the reward. So let's really get our act together in any country where it's necessary. By the way, as an aside, one of the interesting developments, I could almost argue sadly, of all the shocks that we've been experiencing in, past 3 years, is that we have gone to a sea change in terms of the risk mapping of countries. There used to be a time, you ask an economist, what is the risk exposure of a country? What is it? It's growth shocks and inflation shocks. And then you apply monetary policy, etc. And what is the risk exposure that we now have discovered? It is growth shocks, inflation shocks, commodity shocks, climate shocks, health shocks, geopolitical shocks, etc. So what that means is that the way we look at certain countries that at some point in the past we considered to be immune to any type of shock, because there were only two, that reading has fundamentally changed. And that I think is an argument that could be used in a political debate to say, hey, please, we may be a bit exposed to, let's say, a negative growth shock because the hit to the public finances, but look at yourself, you have an exposure to this, etc. Closing that parenthesis, but I do think it's worth keeping in mind. Also to engineer more, as you mentioned earlier in your speech, public sector-based risk sharing. So, but the thing about how can we get it accepted? And indeed, as you mentioned, I agree with you. Ask the man in the street, the proverbial man in the street, banking union. I mean, what is it? And then you have to say, we need to do this, we need to do that, because that way we can finance the banking union. What's in for me? That's really the issue that we have. We could also argue that if it's about the capital waste for public debt, but really the point is that you need to work on what is going to be the success of the Stability and Growth Pact. Now, the concern I have there is that because there's an element of, I would say, finding balances, which is the political correct way of horse trading, and that is that this has now been put under the banner of economic governance, and there are 11 layers that will be discussed at the Commission level and at the Council level. That makes me a bit skeptical on what will come out in terms of new Stability and Growth Pact, and hence makes it even more difficult to make significant progress in terms of having the capital waste accepted.
Linda, I saw you taking notes. Maybe there's something you would like to add?
Just to build on that, I think that it's a very good question. Why is it not working? Why do we currently have these political clashes? It is about politics massively, right? But politics is also tied to economics. So I think that the one big issue that we have is there hasn't been enough show of leadership. And leadership is leading often by example. And there's also trust building. And then together in that kind of process, trying to move the Overton window to what is policy, to reasonable, acceptable, popular, to radical or unthinkable, right? And if you look back at the 10 years before, a lot of the things seem unthinkable, right, that we did during COVID, pre-COVID, post-COVID, so on and so forth. So I think there's a lot more to be done in trying to actually engage more actively and figure out what is the grand bargain that you can strike. Currently, especially, there is an opportunity for that because of the energy crisis, because of the proximity of, for example, the Ukrainian war to certain countries. It's not felt the same way everywhere across the region. So that does offer some opportunities, also some unique challenges that we might need to overcome a few years down the line. But I think that the issue is that the translation narrative, translating why it actually matters for an average person, I'm not entirely sure whether that will work or whether we even need it, right? And I'm speaking as a Latvian who worked many lives ago during the time when Dombrovskis decided to do internal devaluation, right? Try selling that.
Yeah.
The point is it didn't need a selling. Not everything always needs a selling. This is what we're doing, and that's it.
It takes leadership.
Exactly, and the trust either in a leader. So you can actually lead in so many different ways. You can lead through charisma, through competence, through technocracy, so on and so forth. So the ways of leading are very different in each historical and cultural context. So I think this idea that we will need to sell it to the masses, well, we haven't always sold it to the masses, right? There might be the need for a charismatic European going around and, like, you know, building up more support for Europe. But I think at the same time, there's also hard truths that we need to face, that it is about economic fighting. Just let's take taxonomy. Why there was no social taxonomy? That was a big mistake. Arbitrarily, what a lot of people perceived arbitrarily prioritizing the green taxonomy was a big political move, which actually offended people because they were like, well, so now you're gonna sacrifice X amount of people because green is more important. Because guess what? Nobody had actually explained how climate links to social outcomes. So by doing one, it created this idea that it's arbitrary. And some central banks still struggle with that. I'm not going to name them, but I think everybody knows that there's even banks that are not part of the network for greening the financial system, right? Out of principle. And it's a very interesting question to tackle. Well, why not?
Mr. Knot?
Well, I mean, I couldn't help thinking that Latvia and the Netherlands, and Belgium, we're all small open economies, right? So to get sort of agreement around a painful internal devaluation adjustment program in our societies is probably, we have had episodes of that, all of us, in the past. And it's been successful because we've always been geared towards selling our products abroad, exchange rate stability, the exchange rate anchor that also the Dutch Central Bank had before the Economic and Monetary Union. In small open economy, it's probably a little bit easier to find the societal consensus around these painful measures than it is in, let's say, the larger, more closed economies, also in the European area, because these economies then have to take into account the second round effects on what it means for aggregate demand much more strongly than we have, because most of our demand is coming from abroad anyway. So that's the one nuance. I must say 25% real devaluation. I never believed that Latvia would survive it, but it did. So
at great cost.
At great cost, but there was sort of consensus in society to do it, which I don't think you can easily transplant to every European country at this moment.
Well, it was sold as there was no other option.
Yeah, there's no alternative because you wanted to stay in Europe, you didn't want to devalue because you didn't want to join the euro, etc. And you succeeded in doing so. That's remarkable. Like Belgium in the 1990s, the primary surplus that was achieved. A country like Italy, of course, has always had a primary surplus, but never the level that Belgium managed to achieve. Had Italy managed to achieve the same primary surplus than Belgium, it would not have the current high level of public debt. But it is questionable whether in Italian society you can really find the same degree of consensus around running such a high primary surplus than was the case in Belgium. These are, I think, also, that shows that politics and economics always goes together in these things. On the NGFS, I'm completely with you, of course. I mean, I think climate change is one of the big structural change processes in our economy. So yes, it's going to affect central banking in all of its tasks. It's going to affect the volatility of inflation. It's going to change price stability. Price shocks will come from the energy side more often in the future than they did in the past. It will affect our own financial risk management in our supervisory function, the way we look at financial risk management of supervised entities. So yes, I think as central banks, it's perfectly legitimate that we are on top of that, and I think every central bank should be a member of the NGFS without any reservation.
Can I ask a question?
Of course.
From where you sit, right, and it's actually a question to both of you, I wonder, how do you find the search for talent? Because currently, as you mentioned, climate risk will be a major thing, right?
Yeah.
We need really talent to be able to look at it from the financial sector perspective. And I'm not talking about, scientists or whatever. I'm talking about essentially professionals who are trained in economics and finance. Do we have enough of those? Or do we need to also change a little bit the education of when it comes to economics and finance degrees? Because from my experience, which is very humble and much smaller, it's actually very problematic that we don't have educational programs that integrate sustainability or sustainable finance tools and methods and the financial instruments, etc. Usually people have to go and seek the education either through practice or through very short executive educational courses, which are quite expensive, so they disadvantage certain countries.
Yeah, I guess, what we experience as a central bank, if we attract a lot of young staff, because we have a lot of young people that join the central bank, and then sort of after 10, 15 years, they sort of go to different places in society. And if you ask them what is their motivation to join the central bank, sustainability and the fact that the central bank takes a leading role in sustainability is absolutely the most often mentioned answer that we get. Now, your question is a little bit more, should we already not in the educational system adjust? Obviously we should, but that always happens with a lag. And that's, I think, something we should accept. Luckily, training doesn't stop when you leave university. I think there's a lot of training you still do on the job. And I guess sustainability will be a big issue for us, for commercial financial institutions, for think tanks, where have you. So I think there will be a lot of training in this area happening. In that sense, I'm optimistic that we will adjust.
The sustainability focus of people that we recruit or have recruited in recent years is very strong and very high on the agenda. And then, of course, we put a lot of efforts in terms of doing all the training and what have you. So we are not unique. Every bank that has let's say some ambition and strategy in that respect is doing that. I think on the what you have in universities, etc. I just count on market mechanism. The need is there, and you will see that there will be specific programs being developed. If I can just give an example on something else, but that is a very hot topic, and that has been a factor of inflation. There is a supply side management program at University of Antwerp I discovered just by chance, and it has become widely popular, of course. Yeah. Everybody wants to do supply side management because we have seen how much the shock, the disruption has brought, so I suspect you will have enough trainings being developed.
Mr. Knot, you already said that it's important for the ECB to also look at also one of the biggest threats or challenges of our time, climate change. Earlier in July, the Governing Council of the ECB decided to take further steps to include climate change considerations in the Eurosystem's monetary policy framework. Maybe it's good that you can explain to us why now, what does it entail, and is it the role of the ECB to mitigate climate change?
Okay, to begin with the last questions, I mean, our mandate is price stability, and next, that's our primary mandate, and then we have a secondary mandate in which we support the policies of the European Union, as long as they don't contradict our primary mandate of price stability. Well, in the case of climate change and the sort of engagement of the central bank with the subject, you could argue that both within the primary as well as in the secondary mandate, there's a strong case to be involved. In the primary mandate, as I said, this will affect price stability. This will affect the formation of prices over time, and therefore also the way we model inflation and the way we model inflation risks. Look at the current energy crisis. That is a short-term energy crisis, but there is, of course, a longer-term energy, I wouldn't call it a crisis, but at least an energy transition that we will have to undergo that will continue to affect energy prices and thereby also inflation. Now, in the secondary mandate, it's very clear that the European Union has issued several policies, Fit for 55 and other policies, because climate change is going to affect the euro area economy. This transition is a transition that is potentially as big as the transition from agriculture to industry, for us industry to services, etc. I think the whole energy provision will have to change profoundly, and that is going to affect economic growth, economic development. It's going to affect risk-taking. The financial industry is the one that has to sort of channel the financial flows to make the investments move in the right direction. Well, we supervise the financial industry. We ask them to calculate their own financial risk. Climate risks are also creating financial risk. So to incorporate that into the supervisory instruments that we use is also, I think, a very natural reaction.
Why now?
Well, because I guess since the Paris summit, this issue has become so much more topical. I mean, we established the NGFS in 2016, which was in the aftermath of the Paris summit. And from that moment onward, I think the central banking, we were one of the founding fathers, by the way, of the NGFS. And we also pushed that the ECB became member of the NGFS as quickly as possible. From that moment onward, I think we have done what we can. Of course, there are also methodological challenges. There's a lack of reliable data. There's a lack of disclosures. And that's also, with my other hat on as chair of the Financial Stability Board, we have a climate roadmap that we try to get work going on 4 different strands. One of them is actually better disclosures of corporates and banks so that we can actually chart the climate risks much better. More consistent data on both physical risks as well as the transition risks, thinking about sort of more structural thinking about financial stability, vulnerabilities coming from climate change, and the last one is developing supervisory and regulatory practices to deal with climate-related risk. But it needs time. These are new developments, these are new tools that need to be designed, and basically from scratch.
And what does it mean when you say to a bank, your climate risks are too high? What does that bank have to do then?
Well, that bank will have to come up with a transition plan that is Paris compatible. That's one. And secondly, in its financial risk management, it needs to take into account the financial risks that are emanating from this increased exposure on climate risk, because ultimately the climate risk will lead to concrete financial losses, and these losses will need to be provisioned, capitalized, the normal risk management tools that we have for.
Earlier this year, the ECB performed its first climate stress test. How did BNP Paribas do?
Oh my goodness, that's a surprising question. Yeah, I suspect we did well, but I must confess I have not looked in preparation for this conference. How did we do on that test? So,
But what does it mean for a bank and its decision making if the central bank says your biodiversity risks are too high?
well, first of all, you have 2 points. One is banks to varying degrees will either put sustainability, the financing of sustainability and the risk awareness and what you do about it, either very high on the agenda or somewhat lower on the agenda. So that's the first thing. And then, of course, you have the supervisor coming in. And that's, of course, very logical in the sense that if we all agree that there's this new risk, there's the acknowledgement that the risk, the list of risks has evolved, a bit to my earlier point, then of course you need to take it into account. And banks have a key role to play, one, in making the system more resilient, that is more robust when there are climate-related risk shocks that would occur, hopefully not too many, but would occur, so the system needs to be more resilient. The second thing, of course, is that they can help their clients in making the clients more aware. But the clients are exposed to these shocks financially when the shock hits, but they're also exposed to these shocks because of stakeholder pressure. That's a very important point. You can be a company that, and you consider yourself, or a firm, you consider yourself to be rather protected, robust, what have you. If you don't do the right things, eventually your stakeholders will let you drop. They will ignore you. And there again, banks have a role to play to create awareness and to say, well, please, have you thought about this? Have you thought about that, etc. So they have, of course, a direct incentive to do that because you have the supervisor that is putting pressure. But even if the supervisor would not put pressure, they still will do that so that the clients are aware and that the clients actually will be better prepared for the future. Because the expectations of stakeholders, who is that? This governments, regulators, customers, and what have you, the staff, of course, obviously, your point as well. All these elements are very key. And then, of course, they can help, and this as well. I mean, we're a commercial company like all our peers, and then we can help also in arranging the financing and the advice, etc. But there's just a tremendous job to be done. And to your earlier point on staffing needs, because I was thinking that you had that it was actually broader in scope. When you look at the analysis of the European Commission in the functioning of the Internal Market Report 2021, they have analyzed 14 eco-clusters. Go down the list. It is incredible, the resource needs that we will have. Tens and tens and tens of thousands of people, apparently, according to the Commission, are needed in construction sector alone, only for the climate transition. Now, this is a sector that has been praying for staff at the peak of the cycle more than any other sector. So you see how many issues that we have.
Problem everywhere, yeah. Linda, results of the ECB's climate stress test a couple of months ago show that most Eurozone banks don't include climate risks in their credit models. Did that surprise you?
No, sadly not. I mean, I'm a non-executive director for a very successful, well, it's transitioned from a startup to an SME. On paper, the most amazing green company that should really get, also actually the financial fundamentals are there. However, the fact that it's only existed 5 to 6 years means that the lending is actually not great from the mainstream banks. So they would incur actually much bigger interest rates. So it's much more beneficial for them to go for venture capital and investment funds that are friendlier towards this kind of business model, which just highlights with a very concrete example that we do have an issue with how also there is a lending issue inside the system, where the model is still based on very, traditional ways of assessing risk. Green bonds are the same, right? So at the European University Institute, we just did a course on green bonds, and it was fascinating, the passionate debates that we had around what is a green bond and what it should look like and how it's linked to the issuer. And the interesting thing is, it's fantastic that the EU is trying to tidy up the standardization space, because we just didn't even know what a green bond was, really, technically, when you actually looked at user proceeds, et cetera, et cetera. But the interesting thing is now the big discussion is if you issue a green bond that's completely green according to the standard, but it's linked to an issuer that's an airport, or an issuer that is not on a 1.5 pathway and compliant with Paris Agreement, then is it a green bond? Is it not a green bond? Well, technically it is according to the standard, but then the question is, do we actually need to rethink that standard if you want to drive the transition? And then it comes to transition plans, and this is where I see a lot of lack of capacity inside the banks that we've worked with. Because when it actually comes to practice, if you need a relationship manager who will explain to the client, do you have, what KPIs have you set? Are they realistic? Are they ambitious enough? Et cetera, et cetera. There's just not enough push inside the system through the capacities that the banks have. Also, a lot of the effects, of course, hide in SMEs. So it's, again, the good old supply chain issue, right?
The small and middle businesses.
Medium-sized enterprises. And we all know that Europe is a big land of SMEs, right? And they're a powerhouse, actually, of, on average, I think they have much higher employment rates and also much more contribution to the real economy. So then the question is, how do we actually improve the financing of SMEs? And this is where Capital Markets Union could also do a lot more. And if you think about 70% of ESG, or environmental, social, and governance risks, hiding in the supply chain, and this is directly linked to biodiversity and climate, I think there needs to be a much more systematic approach how we tidy up the disclosure space. So it's great to start with CSRD, which will disclose the big companies, but then we really need to start on how do you build the capacity also in the SMEs that are supplying these companies, so that actually our stress testing becomes a lot more accurate. So that, I think, is a completely key thing.
You totally agree?
Totally agree.
Okay, good.
Thank you.
Nothing to add.
Let's open the floor for questions from our audience. If you have a question, I see a hand, second row. Also, if you're looking or if you're watching online, you can also drop your questions in the chat.
Good afternoon, and thank you very much. I have two questions for the panelists. First one regards the World Economic Order. So do you think it's now proper time for another Bretton Woods? And the second question regards the euro area, because we are already, let's say, moving towards recession according to the leading indicators. And what do you think would be the policy makers' decisions or the priorities in terms of policy makers in the short run? And of course, given the fact that in the panel it's somebody from the Central and Eastern Europe, I'm also coming from Central and Eastern Europe, my last question regards the successful integration of some countries in the Eurozone, but the unsuccessful integration of other countries such as Slovenia, where GDP per capita purchasing power parity presented a downward trend since the integration within the Eurozone. Thank you very much.
I think those were directed to you, Mr. Klaas.
I mean, I think it's taking the geopolitical question and the world order first. I think it is unrealistic to assume that we can move back again to a Bretton Woods system of fixed exchange rate globally, if at least we still want to maintain a high degree of capital mobility and we want to at least maintain monetary sovereignty in the big blocks of the world. There is this incompatibility triangle. You can only have two out of these three objectives, but you can't have all of them. And it's logical that exchange rate stability at a global level is simply not achievable at this moment. I also think there is too much heterogeneity in economic development for that. Your second question was about the growth outlook for the euro area. Yeah, of course, I mean, the terms of trade shock that we had to suffer, it was calculated at 5% of euro area GDP by Rolf, and I think that's a correct estimate. I have no better numbers on that. That is going to hit purchasing power quite hard. Thus far, growth has surprised on the upside. I must say that growth has surprised on the upside ever since we came out of the pandemic, by the way. So the demand component in Europe should not be underestimated. It's not as strong as in the US, but it's also too simple to say that Europe is only a case of negative supply shocks. Clearly not. Again, the second quarter was a very positive surprise, by and large, because tourism appeared to be much stronger. So that will also carry us forward, I guess, through the third quarter. So the third quarter, I'm still relatively optimistic. But then, of course, the big question mark is what will happen in Q4, Q1. And it is conceivable that there will be a slowdown. I think that is a certainty. Whether it will take us in recession, that we don't know. In the individual countries, it may. Particularly in Germany, I think the mood is pretty gloomy. But to take it into a recession in the euro area, that is not, I think, a foregone conclusion. One of the very positive surprises continues to be the strength of the labor market. So there is a dichotomy between indicators of slack if you look at the labor market versus if you look at GDP growth. And it may well be that the underlying dynamics in our economy is actually a bit stronger than we sometimes think. For sure, we're going to need that through the winter. So the slowdown, yes, I would subscribe to, but the recession, I think that's still an uncertainty. It's still a foregone conclusion. At least in our projections, we do not yet project a full-blown recession, but that growth will slow down significantly. I think that is beyond doubt. Then on Slovenia, I simply cannot take that question because I would really have to look into the numbers. I have not focused on individual countries, so that is a case study where I have to pass for the moment.
William, do you share that analysis? What are your projections for the European economy going forward? Will there be a recession?
I first would like to say something on Bretton Woods.
Of course.
What happened on Monday was really fascinating because the market is extremely concerned about the fiscal policy stance that is now adopted in the UK, which caused a crash in the gilt market, but which pulled along US Treasury yields on Monday morning. So that kind of shows you that, to your point, the trilemma and the dilemma, etc., we have fully floating exchange rates, and even there, the US is not protected from what is happening, good heavens, in the UK. I mean, this is the reality. So, but on the recession, yeah, I mean, I think for me, the recession narrative becomes a bit concerning because I think what it will end up doing, I'm afraid, is that people who have cash will not dare to spend it, and people who have cash and ideas, companies who have cash and ideas, will be reluctant to proceed with their investments, simply because they say, well, you never know what's going to happen. Now, if you look at consensus forecasts, it has a technical recession, so the 2 quarters of a very shallow extent, if I remember well, Q4 and Q1, admittedly with downside risks. If that's it, I call this a look-through recession. When you're a company, you have ideas, you have cash, you simply look through it. It's really interesting in that respect. In the US, a conference board conducted a survey with CEOs. 81% expect a recession in the next 12 to 18 months. Brief, shallow, limited spillover. If you're in that situation, what are you going to do? Unless you're cash constrained or liquidity constrained, you kind of ignore it. And this is really a hopeful sign, in addition to the insistence that you've put on the strength of the labor market and starting from a high level, etc. And same thing in the US. So perhaps if any effort that we can do together in kind of scaling down the recession narrative, I think would be good.
Mr. Knut.
Yeah, on the labor market, the fact that the labor market is so strong also makes it quite likely that even if growth were to go down, that the run-up in unemployment might actually be quite limited, because there will be a lot of labor hoarding, because those employers that did actually sack their workers, look at Schiphol Airport, they regret it very, very much, right? That they did so, because they have no way of finding the workers again. So the initial reaction may well be for many workers to hang on to their employees and not actually lay them off, given the recent experience coming out of the pandemic.
But there's a strange thing happening in the labor market, because the market is tight, yes, but at the same time there are companies that are letting people go because they cannot be profitable with these high energy prices. So there is both sides, both things are happening right now.
If you believe that energy prices are structurally higher, then some forms of economic production actually will not be viable, and that is part of the reallocation, the dynamic reallocation of resources in an economy. And if anything, we suffer from the fact that this kind of dynamism has been put on hold for 2 years, because our government has essentially kept all firms alive, even the ones that may not even be viable from a longer-term perspective. And that's why we are always saying, be careful with overly generous fiscal support packages, because what you also do is you completely lock down your economy. And normally, an economy needs creative destruction. It needs a certain amount of dynamism. Non-viable firms should fail, so that the capital and the labor that's locked up in these firms can actually move to viable firms and more productive.
Yes, but we are in a very strange situation right now with high energy prices. It's different than during the COVID
Yes, but we're also in a situation where
pandemic.
in the Netherlands we have a positive output gap that we almost estimated 3%. I mean, we have almost 1.5 vacancy per unemployed in the Netherlands. So these people are needed desperately elsewhere on the labor market. Of course, this is not necessarily true for the euro area. I'm not switching to the Netherlands, but
yeah. Question at the front, Graham Bishop.
Yes, I'm afraid another question to the Governor. You specifically mentioned twice about risk-based capital charges for sovereign debt held by banks. Now, rather more than 30 years ago, I used to write to Professor Bitterlich and his colleagues on this question, and was roundly ignored, to say the least. Now we're in the situation where we found it quite difficult to have had the crisis, the 2010 crisis, if we had not had banks being overexposed. Why is it that governments are so reluctant? And one can understand, but when it is so obvious that the market is differentiating and the risk-worthiness, the risk standing, credit rating agencies do the same, why won't governments accept the judgment of everybody else except them and allow this change to go through?
well, that is really a question that you should direct toward those governments that are actually blocking this fiercely. I entirely agree that this is a big, big mistake. I think in terms of economic allocation, risk should always be priced. Because if you have underpricing of risk, the consequence is excessive risk-taking. And that's why you get into the financial crisis like we went through in Europe. Unfortunately, the moment in which you go from zero risk weighting to positive risk weighting is, of course, a difficult moment. And some governments will argue that this is not the moment, because debt is very high, and some governments depend very much on shoveling that debt into the domestic banking system, otherwise they would face much higher financing costs. So it is against their own short-term self-interest. Unfortunately, they are creating longer-term problems all the time by not addressing this short-term sort of bump that they have to overcome.
A question here, and then third row, final two questions.
Thank you so much. This was terrific. I have two really quick questions. I understand the political controversy around banking union and deposit insurance in particular. What's the political controversy that's preventing the completion of capital markets union? That would be very helpful for me to understand. The second question, and this is to you, Governor Knot, you said that the United States has a demand shock that it also has to deal with, and so will have to go further. Did you mean to imply that the landing zone for interest rates in the euro area should be expected to be below the landing zone for interest rates in the United States and also in the UK?
So what was the first? Oh, the capital markets union. Yeah. I don't think that there's actually much political resistance to capital markets union, but one of the big sort of struggles is insolvency law. If you want to have true pan-European investment, you cannot expect from an investor, and definitely not one coming from abroad, that he or she has to acquaint himself with 27 different insolvency laws. Now, the problem with harmonizing insolvency law is that every single country of these 27 is of the opinion that his or her insolvency law is absolutely superior to the other 25 or 26. And that's the problem that has been sort of impeding further progress on this area. Institutionally, these are also not finance ministries and economics ministries. These are ministries of justice that have a completely different take on economic integration and the virtue of economic integration, etc. So I would say it's more a technocratic obstacle that, yeah, it would need a lot of political sort of push to overcome it. But I think that's the main obstacle that is withholding us from more integration. Your second question was about the demand in the US. It's very, very, very tricky to make any statements about terminal rates. What I do know is that if there is a stronger demand aspect to the inflation, you already see that reflected in much higher wages. And wage formation is, of course, the main channel through which you have second-order effects. So you could already say that in the US, the second-round effects are already more pervasive than they are in the euro area. So ceteris paribus, because there is a lot that I cannot take into account here, but ceteris paribus, yes, you would expect terminal rates to be higher in the US. But of course, it will all play out. How sticky will inflation be? And the longer inflation sticks around, we have more product and labor market rigidities in the euro area. So then the verdict, that might actually change the verdict over time. But based on what I see today, I would think yes, because of the sort of higher demand character of the inflation problem.
Can I just add one word on the first question? One of the other areas where really it's a snail-paced type of progress is on securitization, which is really highly, highly, highly needed in the context of the financing of the energy transition. And securitization, I have the impression, by many people is still associated with the mortgage-backed security blow-up in the US. And if we are not able to differentiate between an instrument and a specific set of circumstances in a country or in several countries, then we will never make progress. And another point that strikes me in seeing some of these debates is there is a tendency to add a lot of points to the list of topics to be discussed, which I consider to be of secondary importance in all immodesty. When you talk about CMU and there's a chapter on financial literacy, sorry, it's important, I'm passionate about it, but I do not think that that is now the top priority in making progress on CMU.
Final question.
Thank you. Thanks for the great panel. Let me start with a remark on education. So I fully support what the panel has said, that university education, higher education has to adjust and to start teaching in a way that addresses societal challenges. And I think there's a lot of awareness in, let's say, certainly in the Netherlands, but I think globally to do that.
And you work at the university.
Yes, that's why I'm saying it. As an example, our Master of Economics next year will be completely redesigned to start from societal challenges like inequality, sustainability, and technology, and from there on teach the fundamentals of economics. So, but that's just one example. Then the question. So, going to this secondary and primary mandate of the ECB. So I'm trying to get some feeling of what that means in practice. And I can imagine that there's also trade-offs for the ECB in doing that. So, and I was thinking of the pandemic asset purchasing program as a potential example. So many people have argued that the start of the pandemic asset purchase program, roughly at the same time as the next EU Recovery Fund initiative by the European Commission, was essentially a support program for growth in Europe. So it was driven more by, let's say, the ambitions of Europe than by price stability. But at the time it was, well, that's what many people have argued. You can disagree with that. But now, 2 years later, of course, we got the energy prices, and then, as you said, the ECB was still stuck with this asset purchasing program. So if the first step was indeed, to some extent, driven by the secondary motive, then the next step in 2020-21 might have been compromised or endangered exactly by doing that. So how does the ECB see this type of trade-off in its actual policies?
Well, I mean, I disagree, because with the start of the pandemic, the situation was that inflation had been around 1% for a very long period of time. It was very sort of stubborn. And what does it mean, 1% inflation? Well, first of all, it falls short of the target that we've set ourselves. But secondly, it also means you're very close to deflation. Because if you take the elements of the Boskin report and you correct for the measurement error in inflation, that essentially 1% inflation is price stability. And why do we aim for 2%? Because we want to have a second percent, a sort of buffer, that we don't immediately, with the first negative shock, have deflation, etc. But if you start at 1% inflation and you get the pandemic, which is a huge negative demand shock at that point in time, for sure, your deflation risk as a central bank also increases significantly. So the reason to start PEP was actually to counter that deflation risk. That could be perfectly rationalized from our primary mandate. The fact that it helped government borrowing costs, keeping government borrowing costs contained, through which governments could more easily borrow and then finance, for instance, the RRF with its sustainability investments, etc., that was a nice sort of side effect, but it was not our primary motivation. Our primary motivation was in the core of our mandate, that if you start at 1% and you get such a huge negative lock, of course it's going to be deflationary, and you have to respond to that if you have a 2% inflation target. So I don't see that dilemma, and actually also the exit from the PEP, that was motivated by monetary policy reasons. The inflation picture was clearly changing. At the same time, had we been too aggressive and wanting to get out too quickly, then we would have run the risk of creating financial instability at the markets. And financial instability in the markets also very quickly then again has deflationary effects. So that's why we came to the conclusion, and you can debate whether that was the right conclusion, but that we couldn't do it any faster than having a 10 billion a month reduction. Now, with the benefit of hindsight, people might say, oh, you could have been more courageous, you could also have done 15 or 20 billion a month, and then you would have been out. We will never know, okay? But we thought that this was the best pace in which we would not trigger any financial instabilities that would have thrown us back again had we triggered these financial instabilities in bond markets.
Thank you. Sorry, that's all we have time for. Thank you for your questions. Thank you. Thank you to our speakers in our final panel. Klaas Knot, William de Vijlder and Linda Zeilina.